Welcome to Intermediate Options Strategies. So far, we've learned about the four different basic options, which is the long call, the short call, the long put, and the short put. Now it's time to move our skills to the next level. In this module, we'll be covering spreads. We'll study the philosophy of spreads, and we'll also study the different kinds of spreads like debit spreads, credit spreads. We'll first look at what a spread is and why we use them. Bear in mind, spreads build on the individual option strategies that we've learned so far, and this is just the next step of our options education. So we've looked at four strategies so far. We've looked at the long call, which is a bullish strategy with unlimited upside profits and limited losses. Then we looked at the short call, which is a limited profits but unlimited losses. Then we looked at a long put, which is a bearish strategy. The long put also has unlimited profits but limited losses. And then we looked at a short put, which is a flat to bullish strategy with limited profits and unlimited losses. In all of these strategies, there are pluses and minuses. When we buy options, although we have unlimited profits, we can also lose money if the price of the stock goes against our expectation. So, and those losses can accumulate. Although those losses are limited, they can still become quite large. And we shouldn't get too tempted by the potential for unlimited profits and therefore lose sight on the fact that you could lose a lot of money if the stock goes against your expectation. And when we sell options, we know we are exposed to unlimited losses. And our rewards are limited, but our losses are unlimited. So both these kinds of strategies involve pluses and minuses and risks and rewards associated with both of these. Now, when we introduce spreads in this course, what we are going to try to do is to optimize all of these strategies a little bit more. So we're going to have to compromise here. We're going to have to give up something to get something else. But what a spread does is it takes your individual option position and provides an element of risk control and provides an element of cost control to a single option position. The philosophy of spreads can best be understood by taking the four different examples, and that's what we are going to do in this course. So we're going to look at a long call, understand its pluses and minuses, and see how a spread can balance out that position. And so we'll be doing the same thing for a short call, for the long put and the short put as well. I'm going to take the example of, let's say, Amazon for this particular course. We look at all four trades and see what are the pluses and minuses of each individual option trade, and then or how a spread can mitigate some of these risks and also help us with our cost control or either with our risk control. Today, Amazon is trading for $194.22. It is a live market, so prices are moving right now. And these are the options for Amazon over the next couple of years. Let's look at our June series. And I'm first going to take the example of a long call. So let's say we bought a call. Amazon is currently at 194, so 195 strike price would be at the money. But let's say we went in for the 200 strike call. If I wanted to buy this, let's say we have 10 contracts of Amazon of the June series at the 200 call strike price, which is just a little bit out of the money. And this call is going for about $7.50. So let's look at its risk profile and try to understand this position a little better. So this is what our risk profile looks like. We have the horizontal lines. This is the 200 strike price. This is our maximum loss situation if Amazon does not cross above 200. So on the day of expiry, we have losses on this side And then we have a break even of 207.50 because we paid $7.50 for this option and the strike price is at $200. And anything above $7.50 or $207.50, we have unlimited profits. On the downside, we can lose the maximum of $7.50 per share. So for 1,000 shares, we can lose a maximum of $7,500. So now, what are the pluses and minuses of this position? On the plus side, we have unlimited profits. So if Amazon were to go to say 230, then we make a profit of $22,000 on expiry. That's definitely a plus. But what is the likelihood that Amazon is going to go till 230? It may be somewhat difficult for it to do it. Nowadays, a move of about $10 to $15 is about the maximum that Amazon does. Regardless, but the potential still exists. The chances of Amazon going to 230 may not be very high, but nevertheless, it exists. So there is good upside potential if Amazon moves up. So that's definitely a positive. What are the negatives? Let's say we are wrong on our call, okay? So Amazon earnings are expected in the next couple of days or something else might come up. But let's say we are wrong and Amazon starts to go down and in fact goes down to 184 or 180. On the downside, our losses are capped. That's good. That's definitely a plus. But we're still going to see losses on this position. We're going to see losses if Amazon moves down by about $20. We're going to see a loss of about $5,000. How can we protect this? So this is where the concept of spreads come in. So spreads have a few different advantages. When we put a spread in, we are actually making a compromise. We are giving up on something that we feel is unrealistic anyway, and in return for giving that up, we are gaining something that is quite substantial. So in this case, in the case of a long call, we could potentially sacrifice the potential for unlimited profits on the upside. So let's say Amazon is at 194, we've got our strike price at 200. Let's just say, okay, anything above 220, if Amazon goes to 220, we'd make a nice profit. But let's say if anything above 220, we are willing to give up the profits, but in return for giving up those profits, we should get something in return. And perhaps what we can get in return is maybe limiting your losses on the downside so that we don't face such a big loss of 7,500 in case Amazon starts to go down. So that is the principle of a spread. A spread is a combination of two option strategies. So we know we have a long call here, but we know the other option strategies are also there. There is a short call, there's a long put, and there's a short put. So if this is a long call, this is a bullish strategy, then a short call must be a bearish strategy. And that's exactly what we are going to combine with this long call. So our long call strike is at 200. Now we are willing to give up profits above 220. So if we sell a short call, so now this is a combination of a long call and now we want to sell the 220 short call. So by selling the 220 short call, what are we saying? So let me put up that option also. We can look at this in a combination. So now I'm selling, say the same 10 contracts of the June series, but the 220 call. And when I sell this, I get a credit of $2.08. But let's just look at this particular option where we are selling. So I'm going to uncheck the buy option and only the sell option is checked right now. So let's look at the risk profile of that. And that's exactly what a short call is. Our short call is at 220. So we have all this room. If you can recall the earlier courses, this short call has unlimited losses if Amazon goes up. Let's look at a combination of these two strategies. So our long call goes this way and the short call goes this way. So if we combine the two, let's see what happens. And this is what happens. Our losses now you'll realize has come down to 5,000, our maximum loss has come down to 5,480, but our maximum profit has also been capped at the strike price of 220. So we've given up any upside potential above the strike price of 220, and in return what we got was a reduction in our maximum loss number. Now let's see how this has happened. So this is exactly what a spread is. A spread is a combination of two different strategies. Most of the time it involves either both options will be calls or both options will be puts. This is called a vertical spread. So what we mean by a vertical spread is, if you look at the Amazon option chain, we have a vertical spread. So a vertical spread means it's in the same month and it's in the same option month. So we are dealing with June options right now. We have a 220 call and a 200 call. So we are long the 200 and we are short the 220. So that's exactly what this spread is. So in this spread, we've not changed our outlook. We are still bullish. As you can see, the graph is still bullish. But what we've done is we've limited our profits at the strike price where we sold the option, and in return we've been able to reduce our maximum loss to about 5,400.